in general, government power is growing. And frankly, the American public let the presidency grow.
Do you also feel that we should end the Fed?
Absolutely. I don't think it can be reformed.
Please join us for our next live stream, Sunday, October the 6th at 9 p.m. Eastern. We'll go over current events, past guests, and of course, gold and silver news. Once again, our next live stream will be Sunday, October the 6th, 9 p.m. Eastern. See you then. Hello again, everyone, and welcome to another edition of Silver Bullion Television, SBTV. I'm your host, Patrick Vieira. A bit of housekeeping first. If you are new to this channel or you have not already done so, please do subscribe, click on the bell to be notified on new updates, and do give us a thumbs up if you like what we do. We appreciate your support. Our guest today is Jeff Deist, president of the Mises Institute, where he serves as a writer, public speaker, and advocate for property, markets, and civil society. He previously worked as a longtime advisor and chief of staff to Congressman Ron Paul, during which he worked with countless grassroots activists and organizations dedicated to reducing the size and scope of government. Jeff also spent many years as a tax attorney, advising private equity clients on mergers and acquisitions, and we are delighted to have him here today on SBTV as our guest. Good day, Jeff, and welcome to SBTV. How are you doing?
I'm doing great, Patrick. Thanks so much.
Thanks. We're glad you could be here. Absolutely glad you could be here, and we appreciate the time you've given us. Jeff, I want to start by asking you if you can share with us how you came to work with Dr. Ron Paul, who is known to be an advocate of peace, freedom, sound money, less government power, and more personal liberty.
Well, I think first and foremost, he's known for sound money. So I would really stress that that's I think maybe his biggest gift or achievement is that he got people talking about money in the Fed.
Yeah.
When I was a young guy, when I was in college in 1988, I met him when he was running for president at that time. And over the years, I managed to stay in touch with him. So it was just one of those things where I had a bit of a personal relationship with him, stayed in touch with him, and years later, many years later, actually ended up working for him for a short time.
Yeah, but I mean, I'm thrilled to know that. I'm even jealous a bit. I've always been trying to talk to him or communicate with him in some ways. He was one of the guys that really woke me up. I like that part when he was in Congress and he showed Bernanke that gold coin, and Bernanke is, whatever.
Well, all you have to do is get on a long flight from Singapore to Houston, and you can go meet him anytime you want.
Okay, might have to do that. Company sponsored, hopefully. But with regards to government power, do you see the government having too much of it? And if so, is this happening only in the U.S. or is it a global trend?
Well, I think it's global. I don't mind the idea of globalism in the sense of goods and services. People all over the world want Diet Coke. So Coca-Cola provides Diet Coke all over the world. That's what I would consider good globalism. What I would consider bad globalism is the idea of global governance, which is I think increasing. I think it's a centralizing force in our world when so much of the rest of the world, the business and personal worlds, are moving in a decentralized fashion. We're actually sort of uploading government from the local and regional level to the national level and now to the supranational level. So I do think in general government power is growing. I think in the United States it's growing exponentially, but speaking of our system, the main problem is the presidency itself. The administrative branch, Congress and the Supreme Court, I would argue, really don't matter all that much. We make a big deal of them, but I really think that the action lies within the presidency. I think throughout the 20th century, both Congress and the Supreme Court, and frankly, the American public let the presidency grow into something wildly beyond the powers it was ever intended to have. And that's why today, when we're listening to these awful presidential candidates, they're all talking about their policies. Presidents aren't supposed to have policies. They're supposed to execute the policies of your congressman or congresswoman whom you send to office for a 2-year term every 2 years. And frankly, If you go back to colonial times, we should probably have 5,000 or 10,000 members of Congress. They should probably live a lot closer to you and be a lot more accountable to you than some faraway president. Even though you're in Singapore, obviously you grew up in America, so you know our system. And, one centralized source of power for 320 million Americans is not working. And it's causing a lot of division in society. So it's not just that government's getting bigger and more powerful, it's that it's becoming more centralized.
Okay. Yeah, so we know, obviously government is it's growing, it's getting too powerful. But in your opinion, what should the role of government be?
Well, obviously, if you believe in government, it should be there to protect rights. The role of government is to protect liberty and protect rights, including property. But this is, in many libertarians' viewpoint anyway, this is an oxymoron because government has to abridge liberty and abridge rights in the name of supposedly protecting them. In other words, it has to tax you, it has to regulate you, it has to coerce you in a lot of different ways. And although we're very fortunate, both you and I in Singapore and the United States, to live in materially more prosperous circumstances than many people in the world, that doesn't mean that there isn't a gun and a badge and a prison cell at the end of state power if you thumb your nose at it long enough. So we're not talking about just an academic exercise in governance. We're talking about actual force. And I would argue that most of what government does is counterproductive and actually harmful to rights. So I would argue for little or no government.
Yeah, it's pretty interesting because in general, the Constitution, it protects your rights. It says basically what governments cannot do. And here today we have executive orders, which is the opposite, where it says what governments can do. So it's changed along the way. But moving forward a bit, Dr. Paul, he does believe strongly that we should end the Fed given its repeatedly failure in monetary policy and incessant meddling in the economy. Do you also feel that we should end the Fed?
Absolutely. I don't think it can be reformed. I think it's too late. There are organizations in Washington, D.C. and elsewhere talking about different rules that could be applied to the Feds, that we should have inflation targeting, that we should have GDP targeting. There's all kinds of ideas promulgated now. We have a new MMT, modern monetary theory, which is gaining traction, which is kind of a hybrid between fiscal and monetary policy, using taxes to accelerate or decelerate the economy. So we have all these ideas, but at the end of the day, they really come down to the same thing, which is the Fed as a central planner in our economy. The idea that the Fed needs to tinker with interest rates and the Fed needs to tinker with the money supply, and that by tuning things correctly, we can, create greater prosperity. I don't think that's true. I think money has to be and needs to be something outside of the system of government and politics, just like I think Honda Accords and whole wheat bread at the grocery need to be outside of the government system. So I have a real problem with reform efforts. I think central banking is just doomed to failure because I think it's doomed to political control. There's always an inherent tendency for central banks to inflate because that's always politically popular. It's always easier to inflate the currency than to borrow money or tax people more. That's just a simple political reality. That's human nature. So inflation becomes a hidden tax. It takes place over many decades. It takes place sort of across the economy, although it doesn't affect everybody the same, by the way. It affects the rich far less. So I don't think it can be reformed. I think that people will say to me, Jeff, oh, come on, we're not going to get rid of the Fed and end the Fed as a political non-starter. And why don't you compromise? And why don't you be a little bit more realistic? But I think if we don't set the standard, if we don't explain things in honest terms, then we don't make any ground in winning hearts and minds. And I don't think central banking works. And I think we're about to find out that there's a worldwide problem because the U.S. dollar, which is run by the Fed, is the world's reserve currency. And we have never had a currency shock for a reserve currency. We've had isolated currency shocks over time and over history. But we're in uncharted waters here, and it makes me very, very worried because I don't think the people at the Fed really have a handle on it.
Yeah, completely agree. But okay, so Jeff, let's say we end the Fed. Who then would be the lender of last resort, or do you think we even need a lender of last resort?
I don't, but I fear it's going to become the IMF. I fear that the IMF is going to become the central banker's central bank. If you go back to some of the legislative history around the Federal Reserve Act in the early 1910s in the United States, and if you read David Stockman on this, who's particularly good in my opinion, although he has his own views, the Fed really was designed to be a backstop. It really was designed to provide liquidity in a crisis for commercial banks. And in exchange for that liquidity in a crisis, which almost by definition meant that the commercial bank had mismanaged things because it was coming to the Fed hat in hand, needing cash, that they would pay a penalty rate, that they would pay a higher rate of interest than they might have earlier gotten in the marketplace when they were more solvent. But what ought to be a penalty of borrowing money from the Fed or getting new cash reserves from the Fed has actually become a discount. We have a Fed funds rate which is exceedingly low. We even have interest payments from the Fed on excess reserves parked at the central bank. So we have a very upside down system where instead of being the lender of last resort, the Fed has become an active participant in the economy. It's buying up Treasury debt. In the QE program we've seen over the last 10 years, it bought up worse than Treasury debt. It bought up collateralized mortgage-backed securities and all kinds of stuff that still has not been marked to market. God knows what that's really worth. And so the Fed as a player, as an active participant in the economy, and always there as a buyer of last resort for treasuries, means that Congress can be profligate and spend more than it brings in taxes. It's very, very scary. And look, the Bank of Japan, the Bank of Switzerland, other central banks are even more activist. They're actually buying equities. Imagine if the Fed started buying Facebook and Amazon stock. It's not unthinkable, and it might be coming soon.
You mentioned IMF. When you mentioned them, it seemed like you had a little bit of concern in your voice. What concerns you about the IMF?
Well, I think that if we have another crash in the economy, I think it'll be a global crisis, just like 2008 was, because the United States and Western Europe, when they get the flu, the whole world gets a cough. And I think that if there's another crisis, that'll be used as an excuse to create another layer of governance over us. In other words, the free market will be blamed when, in fact, central banks are anything but free market institutions. And so the IMF and other people in places like the European Union and the UN and the WTO will say, look, we can't keep having these currency shocks, and we can't keep relying on sovereign, independent central banks to conduct their own monetary policy because it affects everyone else. So we need one central bank running everything. And so we need to start with the IMF creating a basket of currencies, maybe that would include gold and silver, but also the yen, the Swiss franc, the dollar, the euro, et cetera, and that we use this as kind of a yardstick or a proto-currency. But then that could ultimately become just a form of special drawing rights, which have existed at the IMF for decades, and we could end up with an SDR standard instead of a gold standard or a dollar standard. And so I think there's a lot of sort of pent-up demand for a single global currency and also a single global central bank running everything. And I think if there's another crisis, again, capitalism will be blamed, sovereignty will be blamed. So it's very frightening.
Yeah, I hear you. Something definitely to be concerned about there, Jeff. Agree with you. But getting back to that Fed, with regard to the Fed's interest in achieving stable prices, why is it that the Fed is always targeting this 2% inflation rate? Is there any empirical evidence that does show that 2% is good for the economy?
2% is bad for the economy. 0 would be good. Deflation would be better. As Jim Grant explains, deflation means we're getting richer. Deflation is why you and I can go buy a DVD player at Walmart for about $60 when they used to cost $1,000 in the late 80s and early 90s because technology and the market made DVD players cheap. And I don't think anybody buys DVD players now. But no, 2% inflation is absolute nonsense. And if you understand the rule of 72, that means prices double very frequently. And none of this came from the original legislation of the Federal Reserve Act of 1913. The idea of a 2% inflation target is very much a central bank, a regulator created yardstick. I personally think that price inflation in the United States is much higher than 2%. I think anyone who actually shops for food and medical care and tuition and all kinds of things, housing, will find that even though some prices are pretty stable, like, for example, gas prices have been pretty stable, actual inflation is far higher than reported in CPI. And so we don't even have 2%. But even if we did, why should we be pleased with losing 2% of our savings every year to inflation? Why is that a healthy thing? And when people think prices going up is always a good thing, why do they complain so bitterly when prices go up for gas, for example, at the pump? It's because we all understand that there seems to often be a disconnect between prices rising and our salaries, our incomes rising. So it's a very serious concern. And if I can suggest anything to your listeners, it's ignore all the white noise you hear about inflation today and ignore all the technical Fed speak and just go back and read Hazlitt. Nobody better than Henry Hazlitt on just demystifying and simplifying what inflation really is and why it's so harmful.
Okay, will do. Just to add to that, we did interview David Stockman a little while back, and he said back when he was with Reagan, there was no such thing as inflation rate that they were trying to target. So this is all new, and I guess, like you said, it's just all a bunch of noise coming in there. But with this 2% inflation targeting by the Fed, it's just one policy based on the Fed's Keynesian models. How did we get to this point where global economics is dominated by the Keynesian school of thought?
Well, that's a good question. It's a tough question. I suppose in some ways it's better than being dominated by Marxism, which was very popular, through the early part of the 20th century in Western academia, including in the U.S. And I think a lot of what we call very broadly Keynesianism and we attribute to Keynes isn't really him. It's more his followers. And of course, we have this vague term today called neoliberalism, which sort of means a certain amount of respect for markets, but also a healthy amount of welfare state and acceptance of regulatory regimes. So we use the term Keynesianism loosely. So in that spirit, I'll use it loosely too. I'll just say what I think of Keynesianism today is this crazy idea that we have to create demand, that the whole purpose of fiscal policy and monetary policy is to stimulate demand in the economy so people will want to go out there and buy more stuff and borrow more credit. And of course, you and I know human beings want more stuff. That's natural. We want a better standard of living every day. We want more stuff and we want it cheaper and we want it faster and we want it now. You don't have to stimulate human nature to make people do that. The question is whether we're productive enough, both in our individual personal lives and on a societal level, to afford the stuff. And so, anyone who thinks about this rationally will understand that a wealthy society has to produce, and it has to get better at producing. It has to get more productive. It has to produce more and more goods and services at lower and lower cost. So it's all about production. Production is where a healthy economy comes from. And if you manage to produce more than you consume, you actually accumulate some capital, and you can invest that capital into future productivity increases. So this is sort of the cycle. But what we're seeing with the sort of triumph of Keynesianism, and we've seen this among central bankers like Alan Greenspan and Bernanke, is that we have accepted the idea that consumption is king. Consumption and stimulus are how you build an economy, and that's how you get to low interest rates, even negative interest rates. And this is not only bizarre in the economic and fiscal sense, but it's bizarre in the cultural sense. We know intuitively that we should save for a rainy day, that we should hopefully accumulate enough that we can leave something to our children and grandchildren. We have to do that on a societal level as well, or else we're in big trouble.
Yeah, our children and grandchildren, they get to university and they're being taught pretty much Keynesian models of economics. Why do you think this is so? Are you seeing economics based on the Austrian school being taught in schools, or pretty much kind of not really there?
Well, it's taught more than it was 30 years ago or 50 years ago, but it's still not taught enough. And of course, schools teach very little economics to anyone, either in high school or in undergraduate. But for actual economics majors, for people who choose economics as a discipline and then go on to get a master's or a PhD, as you say, what they're mostly learning is statistical modeling. They're learning how to deal with empirical studies, how to force numbers into spreadsheets, how to predict the future. The problem is that humans aren't molecules. They aren't atoms. They're not physical particles. They're ornery, resentful, sometimes joyful, sometimes angry, sometimes irrational actors with volition. And that's why economics isn't a physical science. It's a social science. And when you try to approach economics like math, as though there's an equation and that you can express a theory or a law of economics as an equation and balance each side of that equal sign, it leads to all kinds of errors, in my view, and in the view of many Austrians. So I think we're still enthralled to statistics and modeling, but it's not working. Yeah. It didn't work in 2008. Nobody properly understood the derivatives risks in the economy. Nobody, well, outside of Austrian circles and some other, a few other economists, nobody really understood the degree to which housing was operating on vapors. So if you're gonna use economics as some exercise in modeling and statistics and predicting the future, well, you better model correctly. Your statistics better work. You better predict the future accurately, and that's not what's happening.
I think when you have that human variable in the equation, you're never going to get that equation correct. But if the opposite were to happen with where the Austrian school was the dominant economic model taught in schools today and used by policymakers, how different do you think the economy would be?
Well, it would look very different, obviously, if Austrians were running the Fed or the Treasury Department or the Banking Committee in Congress. But of course, look, Austrian economics isn't normative; it's a science. The idea here is not to issue prescriptions to Congress or anybody else. But of course, we would love to live in a world where policy ideas in both fiscal and monetary policy were at least more informed by the Austrian perspective, which I think would give us huge insights into money, which is mostly leave it alone and let it operate on via market forces. Let interest rates rise or fall via the actual savings and consumption habits of consumers. It would certainly give us a lot of insights into the regulatory world and the tax world. So it would be a very different world, but it wouldn't just be a more free market economy, because we think of free markets, you can look at schools, you can look at Adam Smith and the classical economists, you can look at the Chicago school, you can look at neoliberalism, you can look at all kinds of schools of thought. But where the Austrian school would really change things would be, I think, in its view of money and banking as something that ought to be provided by the marketplace, and in its methodology, that we need to get rid of this idea of statistics and aggregates and macro, and that we really need to understand economics as a micro phenomenon, as an individual phenomenon, as a science or an outgrowth of human action itself. And so there'd be more words and less numbers, maybe, if Austrians were, had higher positions in academia.
Well, if that were so, I think more of us would understand economics if there were more words than numbers. But from the perspective of the Austrian school, why do recessions and financial crashes happen from time to time?
Well, there's no question that if you look across an economy, that money and credit creation is what causes booms and busts. There is a cycle that is a business cycle, we call it, but it's really a money and credit cycle. It isn't inherent in the nature of doing business. It's inherent in the nature of central banking, because we want to create money and credit because that gives people short-term stimulus. That makes people happy. That appears to juice the economy for a while. So there's a lot of pressure to do so. The problem is that when interest rates are lower than they should be, when money is more ubiquitous than it should be, that sends the wrong signals to the economy, and it makes you and I borrow and spend more.
Yeah.
It makes families save less. It makes businesses look at a lot of ideas on paper and say, "Oh my gosh, I can go borrow money for 3%. Let's expand. Let's have some new stores. Let's have some new production facilities. Let's have some new, let's have some new growth in what fueled by debt." And of course, what we find out is eventually interest rates rise despite the best efforts of central banks, and so a lot of the prosperity that you thought you had was artificial. And we don't have to look any farther than Turkey, the nation of Turkey, to understand this. And after the crash of '08 in the early 2010s, Turkey was being lauded as a model of economic growth. They were reporting 8% annual GDP growth. And everyone thought, "Oh my gosh, what's Turkey doing? Should they be part of the EU? Let's bring 80 million people into the EU." Well, it turns out that this was all government spending based on borrowing money. And of course, they weren't borrowing in lira. They were borrowing in euros and dollars. So they can't print euros and dollars to pay back. And that's why they're in a credit crisis now. And they were using this borrowed money to do all kinds of infrastructure projects, I should say. And that made their GDP look good. Well, in a nutshell, that's basically what easy money policies do. It would be like as if tomorrow some bank sent you a new credit card in the mail and said, "Hey, Patrick, here's your new credit card. It's got a $20,000 limit, and the APR is only 5%. And you took that credit card and you immediately went out and bought $20,000 worth of fancy stuff for your house, or you took a fancy trip or something. And your neighbors would look at you perhaps and say, Patrick's really prosperous. He's really doing well." So it's appearance versus reality, and we have to produce before we can consume. And all that the business cycle does is it makes consumption appear to be production, and that's not the case.
Yeah. Hey, if I had their credit card, I'd be flying over to Houston to visit Dr. Paul. But we know that the Fed likes to they intervene in the markets. They like to try and guide the markets. Would the Austrian school do anything that may delay or prevent the onset of a recession or economic crash the same way the Fed likes to put their hand in things?
Well, if an Austrian economist like Joe Salerno or somebody was made king tomorrow, that would be an interesting question, because there's no radical fast policy that you could enact that wouldn't hurt a lot of people. There are a lot of people in the United States and across the West who are very dependent, for example, on programs like Social Security and Medicare. And if those programs were suddenly to be eliminated or radically reduced, that would cause tremendous pain, and that would probably cause a lot of social unrest. So as a practical matter, could we end the Fed tomorrow and just let government become far more free market? Could we let the monetary system in the United States become far more free market without any sort of harms or side effects? The answer is no, we couldn't. And so we have to propose alternatives like competition in currency. I think you could very quickly say the Fed is going to continue to operate as it is. It's going to continue the Treasury is going to continue to produce the dollar. You can continue to use these dollars for your bills or to pay your employees, and these dollars will continue to be used to be accepted for tax payments, for example, to the U.S. IRS. But you are immediately allowed to use other forms of money for payment and for tax purposes as well. You can use silver, you can use gold, you can use crypto, you can use foreign currency if you choose to. Maybe you think I should hold Swiss francs. I think you would very quickly see that Gresham's law applies, and a lot of people would prefer other forms of payment to the U.S. dollar and immediately look to protect themselves and diversify. So that I think just the idea of competition in currency is the most pragmatic, immediate, real-world type of proposal or solution that Austrians and libertarians could offer. But as you say, I mean, it doesn't. There's no point being right if there's a huge crash in the world and people are hurting. Standing on top of a pile of rubble and planting an Austrian flag and saying, "See, we were right." That's not the goal. The goal is to help people understand what's going on, and hopefully, so that future generations can move away from this madness and start to rebuild some kind of economy that's based on actual money.
Yeah, I hear you. Jeff, it's been more than 10 years since the last financial crisis. And based on your observations and research, I gather that you do expect another financial crisis in the near future. If so, what would be the cause of this crisis?
Well, it's multifaceted. It goes back for decades. Of course, it goes back to Alan Greenspan in the early 2000s, really sending the Fed into hyperdrive after the dot-com crash, when there was the so-called Greenspan put, which was his signal to investors that he would never again allow a stock market crash of that severity, particularly the one in 1987, and that he was prepared to create as much liquidity as possible to prop up stock markets. So go out there and buy, because there won't be any more crashes. You could even trace things back to before that. You can trace things back to the creation of the Fed. You can trace things back to Ronald Reagan in the early 1980s, when the former Paul Volcker, who was by today's standards very much a Fed hawk, was no longer chairman. And Ronald Reagan encouraged the Fed to inflate. And as a result, during his time in office, the United States went from about 1 trillion in debt to about 3 trillion in debt just during Reagan's tenure. I mean, you can go back and there's so many inflection points at which you might say this is when things really went sideways. And that's what makes our arguments so hard and so difficult, is because you have to explain history to people, and you have to explain cause and effect, and there are some complex steps to how the Fed played such an outsized role in getting us to where we are today. So our job isn't easy, but our job is to just make people think in more conceptual terms and understand that, when you have an organization that's manipulating money, that has a huge and widespread effect throughout the economy, and we ought to understand that rather than just blaming free markets. And you mentioned it's been 10 years since the last crash. Well, let's say the Fed manages to stave off another 5 years. So this is what we have central banks for, to only have a crash every 15 years. This is the great stability. This is the great promise of central banks. Hey, we only have crashes every decade or so. That to me is no system at all. And I think we need to open people's minds to taking a harder look at it.
Jeff, how do you think the Federal Reserve and global central banks will respond this time around when the crisis hits? More money printing?
Well, I think they will. And as we discussed earlier, I think the IMF will get involved. I think they'll start seriously discussing a global reserve currency. I think they may start out, as they've indicated, by talking about having that as a basket of currencies. And if you think about that, that's just a way to ease people into something. This is exactly what happened in the Eurozone countries when they were starting the transition from individual sovereign currencies like the German Deutschmark into using the euro. There was a transition period. There was a period where people still had Deutschmarks in their bank accounts, and then there was a sort of a certain date where those converted into euro. And so they tried to do this slowly so that people would be more accepting of it. And as an aside, they weren't that accepting because apparently Germans squirreled away millions and millions of physical Deutschmarks in their mattresses and closets and drawers because they weren't entirely sure whether this euro thing was going to work, and they're probably still not entirely sure. So I think it would be something where they tried a very gradual approach and eased us into it, because that's how you see all kinds of big statist reforms taking place throughout the 20th century, is they do things gradually. And so even when something's revolutionary, when you do it in kind of a familiar form or under the auspices of an organization that already exists, like the IMF, it seems less radical to people and they accept it better. So I would suggest there'll probably be another Bretton Woods type conference. Mm-hmm. And what will come out of that conference will be an attempt by global elites to create a new IMF-backed world's reserve currency. And that's why I think, it makes sense for people to be thinking about gold and silver, to be thinking about crypto in their own lives, because I'm not saying as an investment, but I'm just saying as a hedge against uncertainty, because I think uncertainty is coming.
Yeah. So, I mean, I think we are headed towards a transition where we're going to transition from the current monetary system to a new monetary system. And as you say, perhaps it may be an IMF type monetary system. But the key is that transition period, that transition. How do you think it's going to look like during that transition?
Well, it's interesting because on the one hand, we all have smartphones, and in that sense, we should all be far more informed about what's going on, let's say, with monetary policy than our grandparents, who had to maybe pick up the New York Times and find an article on the very back page about it. Now we have all this information accessible at our fingertips. You'd think it would be harder for them today to sort of pull one over on us, that we could monitor this. But in a weird sense, I almost fear it's easier, because there's so much white noise, there's so much information, and we're all expected to sort of follow this bouncing ball. And the devil is in the details. I think that Americans have a huge vested interest in maintaining the dollar as the world's reserve currency. Believe you me, that's why stuff is cheap here. That's why an American programmer might get paid $65,000 a year to do the same work that an Indian programmer gets paid $10,000 or $12,000 a year for. If you ask yourself, why is that happening? And is that sustainable? So Americans ought to be clamoring to maintain the status quo. To the extent they're not, I think it's because they don't understand it. So I think what this transition period would look like is it would be framed in technical details and minutia, not in political terms, not in geopolitical terms, not in terms of nations, because I think it's easier to fool people when you bore them. And so you create a bunch of hyper-technical language. You have all these central bank types who went to Wharton and Oxford and Stanford, and you say, oh, they're the experts, and they need to make sure that there's not another crisis, and they know way more about monetary policy than you, Joe or Jane, average reader. And so leave it to the experts. And that's gotten us into a lot of trouble, but I think that'll be the approach. They'll try to bury this under the guise of technical reform, when in fact it'll be radical and revolutionary in nature.
Yeah, okay. Because I think a lot of people they're seeing this type of a Mad Max scenario when this plays out. I guess you're not seeing it that way.
Well, people need to understand that even during crises, if you look at, let's say, Argentina in the late 90s, early 2000s, as an example of what happens in a country when the economy really goes south, it doesn't necessarily mean that it's Mad Max out there. Some gas stations are empty, but some gas stations have gas. Some supermarkets are empty, others have deliveries. Some ATMs work. There can be rolling blackouts of electricity, but there areas where electricity is fine. There's still people getting up and going to work every day. There's just fewer. There's a lot more unemployment. Crime goes up, but there's still people sort of going out and about their daily lives. So I don't think we should just assume that either things are going along as they are today, or they just collapse into some huge Mad Max scenario. There could be an in-between those two extremes, and we could get to it gradually. And I would argue we are getting to it gradually. I would argue that we've already seen slowly a lot of economic misery and hardship in the West that we just accept because it has come on slowly. If you look at some of the homeless camps in California and Seattle, if you look at some of the problems in Europe where young people have very high unemployment, and so they just stay in grad school throughout their 20s, or they live with their parents throughout their 20s. There's a lot of sort of subtle hidden ways that things aren't so great, but we don't see them every day on necessarily like Mad Max. So I think all of this will happen sort of like letting the air out of a balloon slowly, because if we've seen anything from central bankers and politicians, is that they're really scared to do anything radical because they don't want to rip the Band-Aid off. Nobody wants to be the politician who does the right thing but destroys himself politically by saying, like Jimmy Carter said in the 70s, ladies and gentlemen, we all have to be a little worse off for a while. Nobody wants to say that. Everybody wants to promise the sky and the moon. So, I would say that it's already unfolding in front of us. It's
Yeah.
just slow.
Okay, I hear you. Ever since the delinking of the U.S. dollar from gold back in 71, inflation and the loss of purchasing power in currencies have only increased more severely. Savers are punished year after year, and we're just watching inflation chip away at our savings. And what is your view of gold and how different the economy would look today had the U.S. dollar remained convertible in gold?
Well, you'd really have to go all the way back to the 30s for that, for individuals anyway. But it would look very different because the 71 shock to completely delinking the US dollar from gold basically gave the Fed carte blanche to do whatever it wanted. And that means expanding base money, which is the core money supply, which is reserves parked at the Fed and actual currency in circulation. That was well below $500 billion not all that long ago. And it's 8 times over. It's 4 trillion today, even with supposed tapering. So this is an unprecedented financial experiment. We've never seen anything like it in history. We can't look back at history and say, well, this is what's going to happen because it's unprecedented.
Right.
And we don't know what increasing the monetary base, 8 times over is going to do in the long run. And so we just don't know what things might have looked like with a gold standard. But I will say this. The people would be paid an actual rate of interest if the Fed had to be less profligate. I mean, my grandparents could literally just save, not invest, just save a portion of their money every month, year after year. Like most of our grandparents, they lived very modestly. They had a small house by today's standards. They had one car. They didn't have all these gadgets. And every month they just saved enough. And they might get to old age with a couple $100,000 saved, which was literally enough for them to get by. And they did this just by getting 10, 12, 15% on simple, safe savings type vehicles, maybe at their local bank, maybe in a CD. Maybe today, my grandparents didn't have that, but in a simple money market fund. Not even a mutual fund. Okay, they could actually get 10%. The savings rate at which they could accumulate money was higher than the real inflation rate. There was a delta between those two. And through nothing other than frugality, they could get through their later years not working for a while. Now, imagine this today. I mean, this is why the stock markets are where they are, is because institutional investors, average people, little old ladies, as the stereotype goes, they have to go out there and try to get a yield. They can't make 1% in their money market when inflation's 4 or 5. So they're out there, buying Amazon or buying FANG stocks or buying Apple or buying whatever they're buying. I mean, it's absolutely crazy. And so the punishment of savings, especially older people and people on fixed incomes, is one of the greatest crimes in human history. It's a crime. It's an individual crime. It's a cultural crime. And I wish our financial media would actually write about this. I wish there were people at places like Forbes and Wall Street Journal and The Economist who understood this and who could write about this, because it's the untold story of our time, and it is an absolute travesty.
Yeah, I hear you. Completely agree. Jeff, should we go back to some type of form of a gold standard? Would that help things?
Absolutely, we should. I don't think we will. I think that economists in the so-called mainstream have been pretty good at being dismissive of gold, talking about how it would act as some sort of check on the economy, and that there's not enough gold now to meet the demands of a huge global economy, and this and this and that. Of course, all that's nonsense. If you read Saifedean Amos's great book called The Bitcoin Standard, you will understand the idea of stock to flow. And the stock to flow ratio is critical in assessing how hard a money really is. And gold over human history has had a good stock to flow ratio, and thus it's been a pretty hard currency. And look, prices and salaries can adjust. Prices and salaries can adjust. The total amount of money in the system is not the issue. The issue is the hardness of the money. So, how much something costs and how much you get paid is secondary to how far your money goes. That's what you're really interested in. So a gold standard could still work. I think politically it's almost completely a non-starter. I am pleased to see that Judy Shelton, who is a Fed nominee of President Donald Trump, she's not an Austrian. She's more of a supply sider. I would say that she is sort of a Larry Kudlow type. She was tutored by Larry Kudlow for many years. I guess you might call her a supply sider, but at least Judy Shelton understands that there could be a role for gold in the monetary system. And you know what? All these central bankers sort of dismissing her and looking down their noses, they're all buying gold. Central banks are buying gold in record numbers. So if they really believe that there's no role for it in the monetary system, they're lying. Unfortunately, with Mrs. Shelton, she advocates the idea of a fixed exchange rate between the dollar and gold. I think that's a very bad idea. I think gold, like any other commodity and any currency, I think all of these things need to just be allowed to float against one another. Let prices adjust constantly between the yen and the euro and the Chinese renminbi and gold and silver and Bitcoin. Let all of these prices just float against each other. That's the only way we get an accurate picture of what's really going on out there, is the day-to-day faith in these various things. Let the dollar float. No more currency pegs, no more fixed exchange rates. And I think if we had the courage to have a real free-for-all in competing currencies, I think the whole world would be better off. I think very quickly we'd see who is who and what is what in currency markets. I would love that. That is an absolute dream of mine. But, hey, respect to Judy Shelton for at least mentioning gold as something that can put a brake on government spending and Fed largesse. So that's a great thing.
There you go, Jeff Deist. Before we head out, can you let our listeners know more about your work and also the mission of the Mises Institute?
Well, I hope the mission of the Mises Institute is to be a school, a new kind of school, one that you don't have to be young to attend, that you can just go to online and learn and read it as much or as little as you might wish to and as your schedule allows. We have tons of free books, articles, podcasts, videos, you name it. You could spend the rest of your life reading Mises.org. But if you don't want to read the rest of your life, spend the rest of your life reading Mises.org, just follow us on Twitter. Follow me on Twitter at Jeff Deist. Go to Mises.org. We have a ton of free content. And look, our goal is to be an end run around the academic gatekeepers, to be an end run around the financial media. There's so much disinformation around there. And all of this doesn't have to be as complex and complicated as it is. And so I would really recommend that people go to our website, pick up a book like Hazlitt's Economics in One Lesson, and you might find that this inspires you, and actually economics might interest you more than you think it does if you give it a chance.
There you go. Jeff Deist, we thank you for coming on the show. It's been a pleasure speaking with you, and we'll be sure to direct people over to the Mises Institute. Again, we thank you for your time, and we wish you all the best.
Thank you, Patrick.
That was Jeff Deist, president of the Mises Institute, sharing with us about Austrian economics and the Mises Institute. Find out more about the Mises Institute, please visit their website, Mises.org. If you like this video, please hit the like button and subscribe to the SBTV channel to be updated on new content, and do also check out the SBTV podcast on iTunes and Spotify.